Welcome to the Aussie Firebug Podcast, the financial independence podcast for Australians. Hi guys, welcome to another episode of the Aussie Firebug Podcast, the financial independence podcast for Australians, where I interview clever people who have already reached or are on their way to financial independence. Our guest today is Tim Sparks, Senior Key Account Manager at Vanguard. Tim has more than 15 years experience in the financial services industry and joined Vanguard in 2013. In this episode, we unpack one of the most famous investing companies in the world, Vanguard. We go into who Vanguard is and what they can offer investors, explain some of the key investing philosophies, and very excited to chat about the 4 new diversified ETFs that Vanguard released in November 2017 and why they are such a big deal for anyone wanting to reach financial independence. So, without further ado, let's jump into the podcast. Hi Tim, why don't you start off by telling us a little bit about yourself and your background?
Yeah, sure. I've been working at Vanguard for about 5 years now. Prior to that, I worked for another ETF provider. So I've been discussing ETFs with advisors and investors for about 10 years. Really good idea of cross-section of different types of ETFs that are available in the market. Prior to working for in the ETF segment, worked in equity capital markets pre-2007, when it was a little bit more buoyant then, and helped companies list on the stock exchange. So I've been working in finance for it's probably about 15 years now, and currently helping stockbrokers build out or help their clients diversify away from just Australian equities and build out multi-asset class portfolios via the ASX.
Yeah, right. So 15 years in the finance industry, that must have been an interesting time in 2008, no doubt.
Yeah, absolutely. Things have changed a fair bit by then. A fair bit since then. I think a lot of it's been for the better. There was exuberance within the market, and prior to 2007, where the focus wasn't so much on long-term investment objectives, more short-term transactional gains. And I think that the magnifying glass has been put on what investing for the long term actually means. And we're seeing a lot more clients build out asset classes beyond, and investors build out asset classes beyond just Australian stocks. And they're able to do that simply and also with a lot of control via the ASX, and they're using ETFs to do that. So focus on simplicity, control, building out asset classes that are aligned to clients' long-term investment objectives. And I think that we're in a much better place now than we were, say, 10 years ago.
Yeah, nice. That's definitely a good thing, no doubt. Now, you've come on, you obviously work for Vanguard, so a Vanguard expert. For some people in the audience that don't know who Vanguard is, did you just want to briefly explain who the company is and what the company does?
Yeah, you bet. Vanguard, no longer the new kid on the block. 40 years the company's been around. Big name in the US, and building a much bigger prominence here in Australia and across the Asia-Pac region as well. We've got 5.7 trillion in assets under management. They tell me that the first trillion's always the hardest. And we've also got a trillion now in ETF assets as well. So you may find it interesting to note we've got 20 million clients worldwide, so just shy of the population of Australia, and we've got 14,000 crew or employees, and 13,500 of those are in Melbourne, Pennsylvania, which is where head office is in the US, and then Melbourne is the head office for the Asia-Pac region. We've got about 400 people in that city, and I'm from Sydney, so there's 20 of us building out the Sydney office. Yeah,
wow, geez, that's an incredible number to be managing. That's couldn't even picture. We would say $5 trillion. That's unbelievable. So what are some?
They said, They said I think heard a stat. Clients were entrusting around about $1 billion a day to us in 2017.
Wow.
And so I think one of the reasons for that is there's been a fundamental shift away from high cost active management and over to indexing. And so utilizing index investments to build out an asset class instead of trying to outperform a particular benchmark. Don't get me wrong, we're strong believers in active management as well, but it's just got to come at a low cost because that'll give investors the best chance of success. And I think why the business is resonating globally is that we've got a major point of difference between us and other asset management firms, and that's our ownership structure. So Vanguard's run at cost, which means that the cost of our managed funds and our ETFs are much lower than the industry average. And our primary focus is to do the right thing by our owners. So our owners, or Vanguard's owned by the managed funds, which are owned by the end investors. And so due to this unique ownership structure, we're able to pass on the benefits of scale and savings back through to the end investor in the form of lower fees.
Well, now you touched on a few key points that I want to expand on there. The first being Vanguard's philosophies when it comes to investing. Now, obviously, if anyone's read my blog, you'll see that I invest with Vanguard. All my 3 ETFs are with Vanguard. Can you just touch on the index style investing approach that Vanguard uses with a lot of their managements, please?
Yeah, absolutely. It's controlling what you can control, and so we're huge believers in diversification. I think the Australian market is embracing Markowitz and the benefits of diversification that are coming through in portfolios, not just across individual asset classes. So enough stocks across enough sectors within Australian equities. It's diversification across asset classes as well. So that's a really strong point. The asset mix then has to be in line with long-term investment objectives, and probably the most important thing, and that's what's driving index usage, or what's driving index using across the planet is just keeping costs low. It's very difficult to, if you're investing an asset allocation and your costs are around about 14 basis points, if you're doing that by some other investment vehicle where the cost is 60 basis points or 100 basis points, on a large portfolio or a valuable portfolio over a significant amount of time, you end up with quite a big difference in the end result.
Yeah, definitely. And I always, tell people as well, you can't control what the market does moving forward, but you can control how much you pay in management fees, which is one of the core reasons that I invest with Vanguard, because you guys do have some of the lowest, if not the lowest, management fees out there, which is just fantastic. We're talking, as you said, I think the lowest of my ETFs is the VTS fund, which is 0.04% management fee or something like that. So we're talking super, super low management fees. And just on... sorry, you go.
Sorry, that's a great ETF, the US Total Market ETF, over 3,600 individual US stocks, so Johnson & Johnson, Pfizer, Microsoft, and the ETF's just putting a wrap around that, allowing you to trade it in one trade on the ASX. North of that ETF is part of a pool of assets that's north of 450 billion. It's the largest pooled asset vehicle in the world, and clients, as you said, are able to trade that for a super low management cost, and by the simplicity and convenience of the ASX.
Yeah, absolutely, and that's what I love about this style of investing, and it's not unique with Vanguard. You can get ETFs with other companies, but Vanguard's one of the ones with the lowest management fee. But I really enjoy buying, this ETF and an instant diversification across a whole bunch of sectors and a whole bunch of countries, without having to buy those individually. And I also like the benefit of just sitting back, and actually, funny enough, I had 2 dividends from Vanguard paid out to me today. So, you buy it, you sit back and you just watch the dividends roll in, which is nice. I also wanted to touch briefly on you mentioned that diversification that's greater than the Australian market, which I believe only makes up roughly about 2% of the global market, like just Australia. Can you just expand on that and why it's so important to have that global diversification?
Yeah, what we're seeing in the research that we're conducting, we're seeing an overweight self-managed super fund portfolios, Australian investment portfolios are overweight Australian equities and cash. So there's a strong preference to invest in companies that are listed on the Australian Stock Exchange and then hold the remainder in cash, where we don't really view cash as an investment vehicle. And one of the reasons there's a high allocation to cash is that investors aren't really sure what to buy. If they're not really sure what to buy in terms of BHP or CBA or Rio, one of the reasons why ETFs are very popular is because it just allows you to buy everything. And so where we're seeing investment portfolios improved is that ETFs are being used to build out international exposure to complement international equity exposure to complement that Australian equity exposure, fixed income, all via their self-managed super fund vehicles on the Australian Stock Exchange. So what that means is that if you've got a 20 stock Aussie equity portfolio, you can add, you mentioned one of them, you can add VTS, so broad market US equities. You can add VEU, which is developed and emerging markets ex-US. And you have, instead of having 20 stocks, you've got 22 stocks, if you look at the ETFs as a stock. And, but those two additions add over 5,500 individual stocks, across 40 developed and emerging market economies. And so that complements an Aussie equity portfolio really well because, as you said, we're around about 2% of global market capitalisation, and there's some gig sectors that are poorly represented on the Australian market, like healthcare and technology. And so adding in international equities builds out not just a country and currency exposure, but access to gig sectors like technology, healthcare, telecommunications that don't have a huge representation on the Aussie market.
Yeah, excellent. Yeah, couldn't have said it any better. And the last point I wanted to touch on, just with what you were saying before, can you just go into a little bit more as well, the unique structure of how Vanguard is set up, of the owners of who actually runs Vanguard as opposed to other managed funds out there?
Yeah, you bet. The ownership structure, we're a mutual structure. And so you may remember some time ago, NRMA was a mutual company and it was owned by the policyholders. It's that type of concept. And so Vanguard, set up 40 years ago, was set up with the sole goal of doing everything to the benefit of the end investors. And so you needed an ownership structure where the end investors were in the box seat. We're not a listed company or privately owned company where we have shareholders and we're challenged or conflicted to take money in the form of MERs and pass it on to our shareholders, because the shareholders and our owners are one and the same. And so as a mutual structure, we're owned by the managed funds and ETFs, and so everything that we do is to the benefit of them. At the end of the year, we have MERs that we run the business at cost. We have MERs where investors do pay for investments, but anything that's left over is either given back to those investors in the form of lower fees or is used for the development of new investment exposures. Excellent.
So Vanguard's this great company, and I always recommend it to anyone looking at ETFs to check out Vanguard and their super low fees. How can someone invest with you guys?
There's two ways. So if you look at exchange-traded funds and managed funds, essentially they're the same, in many instances, the same pool of vehicles. So you're getting, through a managed fund, you've got exposure to a diversified pool of assets in the asset class that you're looking for. Exactly the same thing with an ETF. You've got a whole lot of stocks or bonds, and the ETF is just putting a wrapper around that. The main difference between the two is just the entry mechanism. If you want to invest in a managed fund, you go to Vanguard's website, You download a form, you fill that form out, and you send that in to us, and you're the owner of units in that managed fund. If you want to invest in a Vanguard ETF, you simply go to your online trading account or call up your broker, and you purchase those. You purchase that ETF the same as you would purchase a single stock. So the same way that you'd buy BHP or CBA, you can buy a Vanguard ETF.
Yeah. So, and this is one of the most asked questions in all the forums, and I get a whole bunch of messages asking me about this exact question, which is, do I invest in the ETFs or do I invest directly with Vanguard? And I always respond with, well, it depends on how often you're going to be buying the investments, is really going to determine which one you should go for. If you're going to be doing, if you want to buy them once a week, put $200 into it, you're probably better off going directly with Vanguard because you're not going to get hit with a brokerage fee every time. Whereas if you're going to do a once-off purchase of, say $5,000 worth of an ETF every month or so, which is the way I do it, I go down the ETF path. Are you finding more people are buying ETFs than going directly with Vanguard or vice versa?
People have been investing in managed funds for a very long time, and they'll continue to do so. ETFs, they've been around for 25 years now, and so they're no longer the new investment vehicle on the block. Compound annual growth rates in ETF usage, it's really high, and so we're seeing an increasing amount of money going into ETFs each year. And I think that the two drivers of that is, one is that there's an increasing amount of exposures that are available, and the second one is that the flexibility and simplicity. And so for those, Australians have one of the highest levels of direct share ownership in the world, and so the fact that exchange traded funds are able to be traded on the same broking accounts that investors are very comfortable with, it just means that it's very easy and simple for them to do. And so we are seeing ETF usage increase at a higher rate. But that said, there's still many reasons to invest in a managed fund, and you mentioned a couple of them. So if you're looking for a regular savings plan, and you're used to investing in managed funds, then we'll also see investors continue to do that.
Now, I've got a question that I just popped into my head because I only own the ETFs. I invest with you guys through the ETF option. Say if you did invest through the managed fund and you went directly with Vanguard. So my understanding is when I want to sell my ETFs, it's like any other stock. I put it out for a sell, and then someone in the market buys, and then I get the money, and that's the transaction's done. How does it work if someone's investing directly through Vanguard? They put in I'm guessing that they submit something, say they want to sell X amount of units in this, and then what's the background? How does it work in the background?
Yeah, absolutely. So you just fill out a redemption order and you receive the money usually around 3 days or 4 days after the application's been submitted. With ETFs, settlement's the same as the stock, so T+3. If you have a bank account that's linked to your trading account, then the funds will be placed directly into your bank account on the third day after the trade.
Right, so much of a muchness then between the two.
Pretty similar. One difference I should highlight is that the ETF tends to have a slightly lower management expense ratio. One of the reasons for that is that when you're trading through the exchange, there's less administration for Vanguard, and so we're able to pass on that cost saving in the form of lower MER.
There you go. That's often a question in the forums, that the ETFs do have a lower management fee usually, and you've just answered that, the reason behind that then. Now, something that popped up into the scene in November last year was that Vanguard had released 4 new products, 4 new ETFs, the Vanguard Diversified Index ETFs. Can you just touch on a little bit about them and who the target audience is for them?
Yeah, you bet. So there's 4 new diversified funds, and they're the first in the Australian market, simple one trade access to Vanguard's global expertise in portfolio management and asset allocation. We've been running diversified funds in the form of managed funds, so multi-asset class portfolios in the form of managed funds for quite some time now. And the methodology behind that is it's driven by what we call it's a proprietary research engine called the Vanguard's Capital Markets Model, institutional grade, multi-asset class portfolio, huge amount of investment acumen that derives from our investment solutions group. And so that's a group that methodology emanated out of the US, and we've got local teams around the world that adjust that methodology for local tax laws and then home market bias. So that multi-asset class portfolio in the form of managed funds, you used to be able to build the asset allocation with differing exchange traded funds. So you could build a multi-asset class portfolio with 7 ETFs, and it was international equities, Australian equities, international fixed income, property, and domestic fixed income. And so with those 7 trades, you'd get access to over 10,000 stocks and bonds, and again across 40 developed and emerging market economies. So that was it's great technology. There's a huge amount, and we shouldn't mistake simplicity with a lack of sophistication. There's a huge amount going into the delivery of these investment vehicles via the ASX, and a lot of work going into what constitutes the optimal asset class mix across the different risk profiles, 4 different risk profiles with the managed funds. So we took it one step further, and we said, okay, well, if we offered these multi-asset class portfolios with one trade, one of the benefits would be is that you don't have to rebalance each of those 7 different ETF investments on a quarterly or 6-monthly or annual basis, whatever the investor wanted to do. And you can simply obtain a multi-asset class portfolio covering all the major asset classes with a single trade. And so this instant access to a widely diversified portfolio, you can do that paying extraordinarily low management fees. Management fees are 27 basis points across the 4 different risk profiles. And so the 4 different risk profiles go from conservative to high growth. And interestingly, I just ran the numbers before our call today, and they've been listed since November, but the majority of the around about 22 million has gone into the funds in the first couple of months, and that's a really good start for newly listed ETFs, with the vast majority going into the high growth multi-asset class or diversified ETF. And so it's an interesting barometer on the risk appetite at the moment, and depending on which research clients are reading, they'll form an opinion on whether that's set to continue. But across the 4 different risk profiles, which is balanced, conservative, growth, and high growth, we've had the most flow into the high growth so far to date.
Yeah, and this is this is such a great product to be out there, because I get the exposure. The 3 ETFs that I invest in is VAS for the Australian market, and that comes with the franking credits, which is always nice, the VTS and the VEU. And between the 3 of those, I get access to, as you said, a whole bunch of developed and emerging markets, different countries, a whole bunch of different companies. But the one thing I have to do, and probably the only bit of management that I really need to do other than like tax time and stuff, is keeping the splits correct, the balance in the weighting to what I'm comfortable with. So every single time I go to buy new ETFs, I have a look at how much I've got in there. I got a little pie chart, and I say, okay, this one needs to be topped up, and that's just the way I do it. But with these new 4 ETFs, if someone is investing in them, you don't have to do that. You just buy the 1 ETFs depending on your risk appetite, and that's it. The the weighting happens behind in the background, and you just buy that one product, and then Vanguard take care of the rest. Is that accurate to say?
Yeah, that's absolutely right. And so the research that we've conducted, a lot of people don't have a rebalancing strategy. And so the research that we've conducted, and we looked at time-weighted, looked at event-based rebalancing, and we found that there wasn't we found that what was important was that you did have a rebalancing strategy. So if you do it, the more often you do it, the higher the transactional costs will be. So you need to look at it in light of that. But having a rebalancing strategy quarterly, 6 monthly, yearly, we found that added around about 42 basis points of performance to a multi-asset class portfolio over time. And so we've taken the administration out of that for you. And so having that multi-asset class portfolio in one trade will be rebalancing the portfolio on a monthly basis for investors.
Yeah, truly is a set and forget asset. Is the dividend reinvestment program available for these four?
Yes, I do. So there is a dividend reinvestment plan on the diversified ETFs.
Great to know. Good to know. One question I got about the Vanguard Diversified Index ETFs, Tim, is do you get the franking credits for the Australian component of that ETF?
Yes, absolutely. So it's the portfolio manager's role to replicate the price, the performance of the index. And so that involves capital growth in the share prices, and then also the distributions. And so distributions are paid into the fund and into the ETFs over time, and then Vanguard pays those out. And so an index that has a distribution of 4% and it's 75% franked, well then you'd expect that type of performance within your ETF or managed fund as well.
One of my last questions, and this is just something that everyone, I guess, thinks about. If someone invests through either Vanguard or through the ETFs and Vanguard goes broke for whatever reason, what actually happens?
It's a good question. So the same consumer protection mechanisms that have been around on managed funds for a long period of time also are there for ETFs. And so client assets, the ETFs and the managed funds, they're fully replicated, and you're holding, and you've got a direct look through an ownership to a pool of stocks or bonds. And so those assets are segregated from the various service providers of the fund, Vanguard being one of them. And so if Vanguard did go belly up, then an interim fund manager would be put into place, and the owners of the ETFs or the managed funds would take a vote on whether they wanted to continue with that new manager or if they wanted to receive their assets back. And if they voted to receive their assets back, then those assets, those stocks and bonds would simply be sold on the market, and the investors would receive the cash on a pro rata basis depending on how many units they owned in the ETF or managed fund.
Yep. So you are always the owner of the underlying asset, and it doesn't matter if Vanguard go belly up, you're always going to get at worst paid out for those assets that you hold.
Yeah. So the owner of the ETF units or the managed fund units, they have direct look through and ownership of the underlying constituents, and the risk there is the level of liquidity in those underlying constituents when you go to sell them. And so Australian stocks, US stocks, very deep, very liquid, very mature markets, very easy to access, easily able to be sold T+3.
Yeah, nice. Awesome. I think we're just about done, Tim. Is there anything else that you wanted to add or just let the audience know?
I just did want to touch on the diversified ETFs. The investment piece, a highly sophisticated investment solution being delivered and easily accessed. And so whether you're, when constructing investment portfolios, whether or not using index funds or actively managed funds, direct investments, or a combination. And so investors would need to consider a range of factors, and they'd have to look at which fund is right for them in light of their circumstances. And so those factors might include investment objectives, their time horizon, risk tolerance, costs, and the need to take a disciplined approach for long-term investing. And so once investors decide on what that is, then choosing a solution that's in line with each of those risk profiles takes a lot of the guesswork out of the implementation piece. And so we think it's better technology that's now available on the ASX, and we're really looking forward to watching those diversified ETFs help investors reach their long-term investment objectives over a period of time.
Yep, absolutely. And I'm going to be doing a little article on those for diversified index ETFs, because I really see them as a staple moving forward for anyone that is wanting to reach financial independence in Australia. I think they're a fantastic investment vehicle. So I'll put that link in the show notes. Tim, thank you so much for coming on the podcast. You've been absolutely fantastic. Appreciate the time, mate.
Oh, thank you. Thank you very much for having me.
Wow, what a great guest Tim was. Hope you guys enjoyed that interview as much as I enjoyed making it. I got a lot out of asking Tim questions, so I hope you guys could get something out of the podcast as a whole as well. It was awesome having Tim on just to share his expertise in Vanguard and also his general experience and expertise in investing also. If you liked that, this podcast, particularly in regards to the 4 new diversified ETFs Vanguard came out with last year, make sure you pop over to the website and check out the article that will be attached with this podcast post. I'm going to go into details of what I think about the new 4 diversified ETFs, who they're suited for, stuff like that, just my general thoughts on it. I'm also working on a web app that calculates potential investment loss through management fees. I'm not sure if it will be out by the time I publish this article, but keep an eye out for that one. And in general, if you enjoy these podcasts and want me to make more, make sure you drop me a comment, ratings on iTunes. Just search Aussie Firebug on iTunes and you'll find me. I'm also on SoundCloud at www.soundcloud.com/Aussie-Firebug. Show notes of this episode can be found on my website, www.aussiefirebug.com. And before I go, I got a new comment on iTunes that I just want to read out now. So Skinny92, first of all, gave me a 5-star rating on iTunes. So shout out Skinny92. They write, as a 25-year-old Aussie male, it's great to have financial content from someone you can relate to. Thank you, Skinny92. Comments like this just make me want me to make more content for you guys out there. So really appreciate it. Really appreciate everyone that takes the time to give me a rating and a comment. So thanks, guys. And I'll see you guys next time. Cheers. Thanks, guys, for listening to another episode of the Aussie Firebug podcast. For links to all of the resources plus an entire transcript of this episode, head over to aussiefirebug.com. Make sure you never miss out on another episode by subscribing now on iTunes or SoundCloud.